Mahesh Patil, Co-CIO of Birla Sun Life MF. He joins us right now on the show. Mahesh, good having you as always. Thanks for joining in. We are at elevated levels, so to say, but a check across all various investor forums seems to be suggesting that India globally is still topmost on the minds of global investors. What about domestic investors like you? How are you mapping the market right now?
Well, I think we have seen a good re-rating in our market in the last 3-4 months, and the valuations are now slightly above the long-term average. But I think if you look at a slightly longer-term view, that's when you look at companies and stocks with the 2-year views, then we are clearly at a pace where we have seen some early signs of recovery in the broad economy, especially in some of the consumer discretionary names like autos, for example. And with earnings growth likely to be better this year and even higher next year, somewhere around 15 to 16% in that range. I think if you take a 2-year view, that the market still looks to be fairly priced. I mean, it's no longer cheap compared to what it was around 6 months back. But having said that, I think the undervaluation, which was there in a few sectors, that to some extent has been covered up. And going forward, I think a lot of the sectors, would do equally well, whether it is the defensives like pharmaceuticals, IT, or even the cyclicals like, for example, the banking or even autos should do equally well. So the undervaluation is no longer there. I think it will be purely driven by earnings growth. So company stocks where the earnings growth would be higher, I think those are stocks, which will be outperforming. And our focus really will be more stock specific going forward.
So Mahesh, what is your sense right now? You know, considering the market seems to have got a little bit sideways and volatile of late. Of course, a lot of it is also got to do with the expiry, which is going to play out day after. But what's the sense that you're getting? Is it wise to perhaps profit take from some pockets or individual stocks and keep some powder dry, wait for a correction to happen in the market? What is it that you're, telling investors?
Well, for investors, I think it's important to really give a clear picture in terms of the medium and long-term outlook, because we don't expect investors to really time the market. So from that perspective, I think even while there might be some pause at these levels and we expect some consolidation to happen and even possible some correction depending on the global cues. But I think that would be pretty temporary and it will be very fast and furious. It's difficult for a retail investor to really time that. So I think for retail investors looking at this market with the next 2 to 3 years, we are saying that continue to invest in this market. Clearly from a portfolio management perspective, at these levels, I think we would be a bit cautious, really looking at stock-specific opportunities. We don't rule out a correction, a mild correction at these levels, depending on how the global cues turn up. We have seen some weakness in the global markets recently. And considering the fact that the valuations in our markets are pretty slightly on the higher side, and also the fact that India is now slightly over-owned in terms of the global context. If you look at the weight of India in the emerging market portfolios, it's at historical high levels. So any fluctuations in the global markets or disturbance over there could lead to some volatility in our markets. But I think that is something which we as fund managers would like would manage a portfolio for retail investors. It's really important to really stay invested even at these levels.
Mahesh, a word on the specific pockets as well, and I want to start off with IT because it's done extremely well in the last maybe a couple of weeks, and the talk is of course of more dollar strength. Now the question is, if indeed that dollar strength and the rupee weakness leads to a bit of a market fall, would IT still be able to withstand it? And two, conversely, could IT actually strengthen further if the rupee were to weaken?
Well, if the strength what we are seeing in the dollar continues, and we've seen that despite the fact that we have seen good flows, FII flows and FDI flows in India, rupee has weakened a bit in the recent past. And I think overall we have seen the IT sector, while there is some impact because of how the rupee behaves vis-a-vis the dollar, but the real outperformance or underperformance for the IT stocks in the medium term or long term comes really from the outlook for IT services, say in US and Europe, and how the demand outlook is shaping up over there. So that outlook looks to be pretty good even for this year. If you look at the IT budgets, while most of the IT budgets are still behind schedule in terms of the target for this year, but we expect in the second half this year the most of the targets to be met. So, and the deal flow pipeline also for most of the large IT companies seems to be pretty good. So I think the volume growth outlook remains pretty strong, anywhere between around 14 to 16% in that range. And that, I think, would be a key driver for the IT companies. Yeah, in the short term, if rupee depreciates further, I think, yeah, it can lead to some upgrade. But I think currently the analysts are anchored around rupees 60 to the dollar in terms of their forecast. If there is a case to believe that rupee would remain at elevated levels, or around 62 or so, then you might see some upgrades coming in. But it's still too early to take that call.
Mahesh, the last time we were chatting with you, you were talking about as to how there is scope of a re-rating when it comes to OMCs because of crude prices going down and the effect on diesel under recoveries as well. What's your stance now on the OMC pack, considering we've seen a fair amount of run-up already play out? And B, it seems like the impending decision on a gas price revision is going to come about very, very soon. What is your view on likes of ONGC and Reliance, etc.?
In the oil and gas sector, we have seen the sector play out, especially the diesel deregulation or the price increases have now gone through. And now with oil where it is, the diesel under recovery is almost zero. So I think to a large extent, the benefit, which was supposed to accrue because of the decrease in subsidies on the diesel has been played out in the oil marketing companies. And you will see that benefit getting reflected in terms of improved balance sheets. The last quarter also we saw the debt for HPCL and some of the other oil marketing companies came down, and I think that to a large extent has played out. I think when the balance sheets get repaired fully, I think you would see some possible re-rating. I think going forward it matters whether the marketing margins for these companies are able to improve and how the competitive dynamics really comes into play, because now you would see probably some of the private retailers also entering into the market, and that's something which one needs to watch and how that will play in terms of market share. But I think to a large extent we believe that it has played out. As for the upstream companies, the oil and gas sector, their gas price hike is something which is still being awaited. I think the quantum of that hike is something which could be lower than what initially market was expecting. And also one has to see whether the hike would be there for any incremental new discoveries, or it could also be applicable for the existing fields. That will really determine in terms of whether it will benefit some of the existing companies like ONGC.
Mahesh, the market is latching on to individual names, irrespective of the sector being in a pause mode or otherwise. There are individual names which the market is really keen on picking up. NBCC a case in point, Force Motors a case in point. We've seen some auto components over the last 3 odd months doing extremely well. Amongst the smaller size names, what space looks to be a definite outperformer over the course of the next 6 to 12 months? I know you can't talk stocks, but is there a broad pocket that you believe as a whole could really move up over the next 12 months?
Well, I think one, as I mentioned earlier and as you rightly pointed out, I think it's getting more stock specific and companies where the fundamentals are good, the balance sheets are strong, and either there is a turnaround or higher growth expected. I think market is now pricing in growth and giving you a premium for that, especially at the company level, much larger. And that's where we are seeing the pockets of outperformance coming through. I don't see that in the small and mid-cap space any particular sector which could really outperform. But broadly, if you look at the sectors, which we feel could outperform over the next 1 year or so, would be like autos. We have seen a decent outperformance in the recent past, both in the two-wheelers and in the four-wheeler space. And if you go back by initial feedback from the dealers, the footfalls are increasing, and this festive season this time looks to be pretty good. Even the discounts on some of the models have come down. So this is a sector, I think, which could see some upgrades in terms of volume numbers for next year. and that could drive certain outperformance going forward. Besides that, other sectors like IT, for example, is something which we think can be a steady outperformer going forward. And also banks, while we've seen credit growth slowing down, it's been at an all-time low at around 10.5%. But the private sector banks and banks which are well entrenched and growing, I think they'll continue to gain market share, and especially the NBFC sector, where we expect some moderation in interest rates in the latter part of this fiscal year, and some pickup in the retail credit. That should mean better earnings growth for some of the NBFCs which are catering to the retail segment.